Welcome to our deep dive on low-interest debt versus investing. First, we will set the stage for the classic financial trade-off between guaranteed security and potential growth. Next, we will compare strategies, show you decision frameworks, and walk through practical steps. Finally, we will wrap up with key takeaways, a couple of quick quizzes, and a clear plan of action. Here is our roadmap. First, we'll clarify the dilemma. Then, we'll set up foundational steps you should not skip. After that, we'll walk through a decision flowchart, compare snowball and avalanche methods, and then outline the investing case. Next, we'll consider smart split strategies and a realistic timeline. Afterward, we'll test your understanding with short quizzes. Finally, we'll close with key takeaways, an action plan, and a brief disclaimer. Now let's move into the core dilemma. The core question is whether to prioritize guaranteed returns by eliminating low-interest debt, or to chase higher expected returns by investing. On one side, extra payments toward debt provide a certain return equal to the interest rate you avoid. On the other side, investing may yield higher returns historically, but with risk. With that in mind, let's set non-negotiable foundations before we even decide. Before making any decision, ensure two prerequisites are met. First, set aside a starter emergency fund of at least $1,000 so that small emergencies do not push you back into higher interest debt. Second, if your employer offers a retirement match, contribute enough to capture the full match. This is typically an immediate and risk-free return that can exceed most loan rates. Once these are in place, you can consider whether to emphasize guaranteed security by paying off debt or to pursue higher potential returns in the market. As a mental model, remember that your expected edge from investing roughly equals the market return minus your debt's APR, adjusted for your personal risk tolerance. Next, let's visualize the decision with a flowchart. Follow the decision flow. First, verify you have at least a $1,000 emergency fund. If not, build it. Next, confirm you are capturing your employer match. If not, do that first. Then consider your debt interest rate. If it is at or above 5%, favor paying off debt, prioritizing the highest rate balances using the avalanche method. If it is below 5%, assess your risk tolerance. If your tolerance is low, choose to pay off debt, perhaps using the snowball method for motivation. If your tolerance is high, maintain minimum payments and invest the extra in diversified, tax-advantaged accounts. Finally, schedule periodic reviews to adapt as balances and markets change. Now that we have the framework, let's compare snowball and avalanche directly. The snowball method targets the smallest balances first. This delivers quick psychological wins that can improve consistency, but typically results in paying slightly more interest overall. In contrast, the avalanche method targets the highest interest rate first. This is mathematically optimal for minimizing total interest paid, though early progress may feel slower. Choose snowball if motivation and momentum are your primary needs, and choose avalanche if minimizing interest cost is your top priority. Next, let's examine the payoff case in more detail. Paying off low-interest debt provides a guaranteed rate of return equal to the interest you avoid. If your rate is around 5%, that is a strong, risk-free outcome when compared with uncertain market returns. As balances decrease, your monthly cash flow improves, which can be redirected to savings or investing. The psychological benefit of debt freedom can also be significant. However, remain cautious during any deferment or forbearance periods, because interest may continue accruing. For execution, automate extra payments to ensure consistency. Use the snowball method to build motivation with early wins, or use the avalanche method to minimize total interest paid. Next, let's consider the investing case for low rates. If your debt rate is around 3 to 4%, directing extra cash to investing can outperform debt payoff over the long run, assuming markets deliver their historical averages. Continue making minimum payments on the debt while investing the surplus in tax-advantaged accounts, like a 401k, traditional IRA, or Roth IRA. This approach exploits financial arbitrage by using relatively inexpensive debt, while seeking higher portfolio returns. Keep a diversified allocation, automate contributions, and ensure your risk tolerance can handle volatility and drawdowns. The simple heuristic is that your expected investing edge equals the market return minus your debt's APR, recognizing this is not guaranteed and may vary after taxes and fees. Next, let's quantify scenarios at a glance. This table frames common situations. First, compare your debt APR with a realistic expected market return after taxes and fees. If the spread is meaningfully positive in favor of investing, you may prefer investing. If the spread is small, or your risk tolerance is low, the guaranteed return from payoff is compelling. Always remember taxes, fees, and behavioral consistency can erase a thin expected edge. Next, we will visualize a smart split strategy using a pie chart. A practical compromise is to divide extra cash between investing and debt payoff. For example, allocate 60% to investing and 40% to additional debt payments. This approach helps you capture potential market upside while still accelerating your path to debt freedom. Adjust the ratio according to your risk tolerance and time horizon, and revisit the split each quarter as your circumstances evolve. Next, let's lay out a timeline of milestones. This timeline organizes your first 2 years. Immediately, build a $1,000 emergency fund. Next month, confirm you are capturing the full employer match. In months 2 and 3, select your strategy. Either a payoff focus using snowball or avalanche, or an investing focus if rates are low and your risk tolerance is high. From months 3 through 12, automate and execute. At month 6, review your plan and rebalance investments if needed. At 1 year, celebrate progress and consider raising contributions, especially after any salary increases. At month 18, reassess interest rates and balances and adjust your strategy. By month 24, you should reach either a major debt payoff milestone or a significant portfolio milestone. Now let's convert this into a concrete step-by-step plan. To implement, first list all debts with balances, interest rates, and minimum payments. Second, build a $1,000 emergency fund. Third, ensure you are capturing the full employer match. Fourth, select snowball for motivation or avalanche for maximum savings if you choose payoff. Fifth, if your debt APR is below 5% and your risk tolerance is high, direct extra funds to investing. Sixth, automate everything to remove friction and improve consistency. Seventh, review quarterly to rebalance, adjust your split between investing and payoff, and track progress. Next, let's test your understanding with a quick quiz. Question: if your loan APR is 4% and you reasonably expect 8% long-term market returns, which choice has the higher expected financial edge, assuming you can tolerate risk? Options are: 1. Pay off the 4% loan early. 2. Invest the extra cash. 3. Split 50-50 by default. Or 4. Do nothing and hold cash. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to invest the extra cash. The expected edge in this simplified model is approximately the market return minus the debt's annual percentage rate, yielding around a 4% advantage in favor of investing, assuming your risk tolerance and time horizon are appropriate. This is not guaranteed, and taxes, fees, and behavior can affect results. Next, let's try another scenario-based question. Question: which foundations should you build before choosing between payoff and investing? Options are: 1. Emergency fund and full employer match. 2. Only emergency fund. 3. Only employer match. Or 4. Neither, and just start investing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is emergency fund and full employer match. Establishing a basic cash buffer prevents small setbacks from causing bigger financial issues, and capturing the employer match is often a high, risk-free return. With foundations confirmed, let's cover common pitfalls to avoid. Avoid typical mistakes. First, never skip the employer match, as it is often equivalent to free money. Second, be cautious with deferment or forbearance periods, because interest can continue to accrue. Third, avoid chasing speculative positions and instead maintain diversified exposure. Fourth, automate your strategy to reduce friction and avoid frequent, impulsive changes. Fifth, remember that taxes and fees can reduce your realized returns, potentially eroding any expected edge. Next, let's briefly state an important disclaimer. This content is for educational purposes only and does not constitute financial, investment, tax, or legal advice. Your situation may differ materially. Consider consulting a qualified professional before making decisions. With that clarified, let's consolidate the key takeaways. Summarizing the lesson: begin with a basic emergency fund and capture any employer match. If your debt rate is 5% or higher, Paying it down often makes sense because the return is guaranteed. If your rate is closer to 3 to 4% and you can tolerate risk, investing may offer a better long-term outcome. Use the snowball method for motivation and the avalanche method for maximum savings. Finally, automate your plan, review quarterly, and adjust as needed. Now let's conclude with a concise summary and your next action. In closing, the choice between paying off low-interest debt and investing is a balance between certainty and potential growth. Use the decision flow to align your approach with your risk tolerance and goals. Remember that small, automated steps consistently applied often lead to substantial results over time. Finally, here is how you can support the channel and keep learning. Thank you for watching. If you found this helpful, please like the video, share it with someone who might benefit, and subscribe for more content. In the comments, tell us whether you are prioritizing payoff, investing, or a split approach, and why. See you in the next video.